Who'd like to know a bit more about charting?
Yeah.
Do you think that would be an important thing to know? Very. Well done, Jack. Okay, selecting the share. Now, because this strategy, the protected buy right, is about owning the share, we'd like to select shares that are in an uptrend for capital growth, don't we? Even though we have put options that protect us when it goes down, overall we want to make the income from the call options, but as well we want to make capital growth from the share. Okay? Now, to do analysis, we use these things called charts, and that's called technical analysis in order to determine the trend. So let me tell you a bit about bar charts. These are the little price bars that we look at on our charts. I'm just going to give you a bit of information about that. Bar charts are simply, these charts are made up of a series of price bars. Price bars strung together over a period of time. So let's just look at me. Okay, just looking at me for a second up on the board here. I'm not very good at doing that impersonation. Okay, this is a bar chart. Can you see all these little symbols? Some are red and some are green. Okay, some are red and some are green. The green ones are simply when the closing price of the most recent day is higher than the closing price of the previous day. In other words, you've had an overall up day, and the red ones are the opposite. So, each of these symbols represents an entire day's worth of trading information. And how charts work is you simply have, you see you've got these prices on the right side. It starts at $9.20, in this case goes up to $11.90. And the more information you have on the screen, in other words, the more zoomed out you are, the more historic the information is on your left-hand side. So this is most recent. That's as long ago as there are a number of bars here. Do you get what I'm saying? Okay, so imagine time is down the bottom here. All good? Now I want you to notice that there are actually 4 components, interestingly enough, to each of these bars, even though it looks like 3. Because let's just take this big one here. See this big one here? See how it's got this left what's it? In other words, the left jigger that sticks out, the bit that sticks out to the left. And then it goes up to the top and then comes down, and it's got a bottom, it's got a top, and then it's also got a right what's it. By the way, they all have a left what's it, they all have a bar, and then they all have a right what's it. Also known as thingamajigs or whatchamacallits. Okay, is that interesting? Yep. Very good. Great. Would you like to know what the whatsits and thingamajigs and represent? Oh, you would? One person. Fantastic. Let me tell you then. So remember, you've got a left whatsit, up and down, and a right whatsit. Whatever that left thing is there represents the opening price. Share market starts trading at 10 a.m. In fact, the share market opens alphabetically starting at 10 a.m. Did you know that? So the A's are at 10, and then a couple of minutes later you get the B's, or 1 minute, C's, D's, E's. So yeah, too much information. Oh, what happened to the wow? Who cares about that much how? Okay, and then the top of the bar represents the highest price reached, the bottom of the bar represents the lowest price reached for that day, and wherever that right bit ends up is the closing price. In other words, when the market closes at 4 p.m, whatever the last trading price was for that share will represent your closing price. Now, I was once due at a party. It was a family birthday party. And I thought of this great animation just before I went to the party, and I said, look, Freya, it's only, look, can I come an hour late? Yeah? Because I've just thought of something that really, really helped my students. Anyway, I completely missed the party because I got so involved in this animation. So I got so busted for it. I hope you enjoy it. Okay, so let me show you. So we've got our price scale on the right-hand side here. Okay, so if you had an opening price for a particular share of $10.23, see $10.23, somewhere between $10.20 and $10.40. Okay, and then let's say at some stage through the day it traded at $10.95. In other words, someone was willing to pay that much, and someone was willing to sell it for that much. And then at some stage during the day, it traded for $10.02. So this can happen during a normal day on a share. And then at 4 p.m. when the market closed, the last transaction went through at $10.70. Would you like to see what the bar would look like Yes, you would. Of course you would. I got so busted for this. Okay, so see how that lines up with the opening price? See that? And then that will go to wherever the high was. It lines up with the high. And that will go down to the low. And then that will line up with the close. Oh my God, the skills of the man! Party pooper. Party pooper. Oh no, that's right. They missed out on some good beer drinking time, but guess what? I'm proud of it. Okay, did it all for you. All for you. Okay, so that's how bar charts work. Support and resistance lines. Let me introduce a new concept to you, also relating to charting. Support and resistance lines are simply horizontal lines which we draw on our charts to define tops and bottoms in the price action. You understand that the share market, or for a particular share, will oscillate regularly. It will go up and down all the time. That's just the nature of the beast. It's all about supply and demand, either how excited the marketplace is about a share, in which case they want to buy it, or how concerned the marketplace is about the share, in which case they would want to sell it. So what drives prices up is when you have an increase in buyer demand. In other words, you've got more people willing to spend more to buy the share than people are wanting to sell it. Share price will go up. If people are more eager to sell than other people are to buy, share price will go down. Okay, so these lines represent significant turning points in price behaviour. The more times the share price hits and rebounds from its support and resistance price levels, the stronger those price points become. Who'd like to see a diagram? God, one person. Okay, so what we're looking at here are tops. See those tops there? And you see that this is like a bottom point, and the share price came down and then went up and then came down. Okay, so let me just illustrate it to you this way. God, how much drinking time this one take? Okay, so what we do is if we identify those high points, we draw a line through it. Now what I want you to observe with this particular share, can you see how they had almost reached that price point and then it went down? Then it came up and reached around that price point, not always to the set, and then it went down from there. Then it came up towards and then went down. Then it came up towards and then it went down. So you can see that historically, whenever this share price has reached that price level, it has gone down from there. So if you were considering buying the share and this was there today, would you be excited to buy these shares? No, because there's a strong possibility that it might go down, just based on historic information. Does it mean that it's definitely going to go down? No, it's just that statistics will have it that the market has always felt for this share that that was a high enough price to pay. See, people will pay for shares based on what the earnings of the company is. So who's ever heard of PE ratio? PE ratio is simply the price that the market is willing to pay for a share in relation to the amount of money that the company is earning per share. See, when you buy shares in a company, you are actually a part owner of that company. So any earnings, in other words, the profit of that company, is yours for the proportion of shares that you own in the company. So therefore, the PE ratio is simply a comparison of how much you're paying in price for the share in relation to the earnings per share. So another way to think of this is, the bigger the P in comparison to the E, the worse the deal you're getting. Because you're paying a high price for not much earnings for the company. Yeah? And the smaller the P in comparison to the E, the better value that you're buying. Now Warren Buffett, who's the wealthiest investor in the world, and he's done it entirely out of the share market, he says you can pay, say, $100 for a particular share and have that be cheap. Yet you could pay $2 for another share and it could be extremely expensive. Do you get the point? Because it's the comparison between the P and the E. So what I'm suggesting to you is if this share continues to get to this P, and that P is too big for the E, the market will go, hey, I'm paying too much. Another way to look at it is this. If you have, is this too much information? No. If the price is, say, at, in this case, $15. Oh, that's hard to do. Can I use simpler numbers? Let's say it's at $20. And the earnings of this company is $2 per share. Then that would give you a PE ratio of 10. Now, what I'm suggesting is the higher this number is, the worse the deal that you're getting. In fact, if you're paying $20 for a share that's only earning you $2 per share, because remember, any shares that you own in a company, the profits are yours because you're a part owner. So if you pay $20 for a share price and you're only getting $2 a year in earnings, how many years is it going to take you to get your money back? 10 years. Whereas if you are only paying $2 for a share earning $2 a year per share, the PE ratio would only be 1. Would that be a good deal? Yep. Absolutely. Okay, good. Fantastic. Love that stuff. Just love it. Okay. So, that is often the reason why share prices will reach certain price levels and go down. So what will cause it to break past that is if what goes up? Earnings. The earnings of the company. In other words, they introduce a new product that absolutely kicks butt. Or they get a new manager in, or they get more market share, or they buy another company and that makes them stronger, or they get their costs down through smart economics, or a whole bunch of things. Do you get what I'm saying? And as soon as their earnings go up, the market goes, oh, good deal, really good, low PE. Okay, very good. Enough of that. So similarly, if I continue to draw these circles, you see these are low points. So this might be a place where the price was low in comparison to the earnings, and so therefore the share price would drop to it and then go above, rise from it, etc., etc. So let's just draw lines through here. Okay. Now there's two factors involved. There's general market cycles that will influence share prices. Also, the individual company and what they're doing. See, there are times in the economic cycle when a company is actually doing no better, but people are just very excited about the share market, and people will actually be buying shares at overinflated prices. So no wonder you then get a market crash, because they go, hang on a minute, we've been buying this shit for years. How much is this company actually making? Not much. And so the people who know what they're doing, the institutional investors, will say, hey, what a great time to take profits, because these dummies do not realise that they're overpaying at the moment. So let's get them now. And they start to sell, and then the market reacts to it. Let's talk about trends. These are pretty trendy. That's something funny. So what does a trend tell us? What does a trend tell us? Trend tells us the direction of the market. Tells us the direction of the market, but it also tells us two other things. And this is very interesting. People are not always aware of this. It also tells us the intensity of the market via the slope. So look at me for just a second. If I had an uptrend relative to you that was like that, and I also had a different uptrend that was like that, which one is more intense, the first or the second? The second one, fantastic. And the third thing that a trend tells us is how healthy it is by how long it's been going for. How long it's been going for. So, the interesting thing is this. The longer a trend has existed for, the more likely it is to continue. Yeah? So if you've got a company that's been in a 12-month uptrend versus a company that's only been in a 1-month uptrend, do you know the company that's been in the 12-month uptrend has a greater likelihood of continuing than the 1 month? Isn't that the opposite of how you would think of it? Some people would think of it? Yeah. Because let me bring it back to what I've just explained to you. If you have a company that's been doing exceptionally well economically for a long time, good products, great market, everyone knows them, they're in a monopoly, they've got no competition that even comes close to them. They've got high profit margins because they have no competition. It is like a household name, like Coca-Cola, say for example. Yeah, everyone drinks it, yeah. If they've had great management, and have continued to just absolutely obliterate any competition who's even come close to them for decades, isn't the chances that they're going to continue to do well? Whereas if a company that's really had trouble, they change their products regularly because they can't find a good market. They're in a highly competitive industry where everyone else is trying to kill them on price. So the only way they can increase their profits is to reduce their costs. But even then, it takes a lot of engineering and it only lasts them for about a year. And then next year, the competition's doing the same thing. In other words, they are a commodity product. Yep. In other words, people only buy that product because it's cheap, not based on brand. You get the difference? So if you have a brand recognized company that absolutely obliterates any competition, they will continue to obliterate any competition moving forward. But if you get a company that just makes a one-off announcement, this month we've just invented this new thing that's like green flavour that we've never done before, and the share market gets excited, it hasn't proven itself. It hasn't been a sustainable advantage. So if the competition then comes up with another product, they're going to have the spike, but then they're going to be like everybody else. Do you get the concept? So the longer it has continued, the longer the trend has been going, the more likely it is to continue, if you just think of it logically. Similarly, another thing that people do wrong, if a company has been in a downtrend, just because you buy that share doesn't mean it's going to go up, is it? Aren't people motivated to buy shares just because they're cheap? Yeah? That's right. People are discouraged sometimes from buying shares in an uptrend because they think it's overpriced. But if you look at this and this, you might find that this is also growing. And while this is growing, it's okay to continue to pay that because the ratio of them are kept in alignment. But some people would buy shares in a downtrend just because they're cheap. But if you looked at the earnings, you'd see that they're really small. That's why the share's in a downtrend, okay? So that loses its sizzle, doesn't it? Now, there are three types of trends. There are three types of trends. One is an uptrend, one is a downtrend, and another one is a sideways trend. Now, the thing about this is you're looking at a sideways trend, but just for that period. One might argue that, hey, hang on, Jules, that was in a downtrend over there and it's in a massive uptrend over there. So how, when I'm looking at a chart, do I figure out what really is the trend when the thing is all over the place? Would you agree with that? That would be confusing. Would you like to know a very simple three-step process of determining the overall trend? Yeah. Okay. I wasn't planning to tell you this. I can't remember. Oh, okay. By the way, an uptrend is caused by an increase in buyer interest. Buyer interest. Okay, in case you haven't worked that out yet. I think you have. How to determine the overall trend. By the way, if you have found this evening extremely boring, and I know some people do sometimes, can I ask you just for the next 2 minutes, just to wake up, just for the next 2 minutes, because I promise you, if you get this concept, you will outperform massively all the silly decisions that other people make by not understanding this concept. Okay, would it be worth being awake for just this? This in itself could make you hundreds of dollars, possibly even thousands of dollars of paper trading money. Now I'm laughing at my own stupid jokes. Okay, when I'm trying to figure out the trend for a share, I actually note 3 time frames. How many time frames? 3. Just 3. This is to determine the overall trend. Okay? The overall trend. Now I know I'm speaking to you with the back of my head, but I'm trying to do multiple things at once. And if you haven't figured it out, I'm a male, so that makes it extremely challenging for me. Very, very difficult. I've actually got an itch as well, and it's confusing the crap out of me knowing what to do. No, I'm just kidding. Okay. By the way, it's been proven... okay, I'll leave it at that. It's been proven statistically that women are far better at this subject than men. It's been proven statistically. They did a survey of 64,000 traders, share market traders in the US. A number of years ago, it was proven statistically that women outperform men on this subject. So, you're asking me to explain why? I'm a bloke. At least ask a chick. I don't know. We're stupid. Okay. Sorry, guys. I hope I haven't offended you. I am one of you, okay? Remember? Before you start. Male, that's exactly right. Males are gamblers. I'll teach them all of this. They go, no, let's mess with it. Women will go, okay, no, look, I've done cooking, I've done baking, and I know if you follow the recipe, you get a great result. And over time, as I want to, add my own touch to it, I'll do that with the experience. Guys go, let's mess with it straight away. Yep, sorry. Anyway, so when I'm trying to determine the overall trend, I look at three time frames. The first thing I look at is the 12 months, which I'm referring to as the long term. Now, long term in other strategies could be 10, 20, in some strategies could be like 20, 30 years. So long term is definitely not 12 months, generally speaking. It's just that the nature of these strategies that I'm sharing with you are based on short time frames. Okay? By the way, you don't become wealthy based on short time frames. Wealth is created over time. Short time frames can generate income for you. They can give you income or cash flow. But ultimately, I'm sorry to say so, these strategies alone will not make you wealthy unless you actually siphon off the profits from it and put it into more conservative, lower risk, longer term strategies. That will make you wealthy. Okay, so buy and hold shares or property and that sort of thing. Okay, so bust another bubble. God, this is really starting to get ugly, isn't it? Now, remember bar chart, whatever is on the right-hand side is where we are today, most recent. So when I'm trying to get the overall trend, I simply look at where we are today and I go back 12 months on my chart. In other words, I zoom out 12 months of my chart and I say 12 months ago, where was the share price? And if the share price was, say, down here, what can you tell me about the 12-month trend? It is up. So this is equal to up. So that's one time frame. But is that enough? I'm interested in looking at 3 of them. Fantastic. The next thing I'll look at is the 3 months. And I'm calling that the medium, just for this strategy. And if I'm here today and 3 months ago I was there, what can you tell me about the 3-month trend? It is up. Okay, and the final thing that I look at is the last month. Okay, and if 1 month ago, which I'm calling the short term, if we're there today and a month ago we were there, what can you tell me about the 1 month trend? It is also up. Only when all 3 of these, how many of them? All 3 of them say the same thing, only then would I actually conclude that the overall trend for this share is up. Now if, say that one was not up, but it was D for down, what would I do? Would I call it an uptrend? No. Would I call it a downtrend? No. It's all over the place, isn't it? So what would I do? What would I do? I'd go sit on the beach. Pass on this opportunity. Look for a different one. The secret to trading successfully is not about when you get in or when you get out. It's all about knowing when to wait. When to wait. When to sit on your brain and do nothing. That is the key. People think, see, people are in the habit of actually making money by being busy. In fact, a lot of people get paid by looking as busy as they possibly can. It's got nothing to do with the level of productivity, but it's just based on doingness. Suddenly you're talking about a concept here where it's about sitting around and waiting for the right opportunity and grabbing that one. And that one makes all the difference than consistently going in and out of the market. Because the transaction cost will kill you. Okay, so discipline. Now, I've finished explaining the protected buy right to you. I'm now talking to you about charting. Now, these charting techniques I'm talking about will work on any strategy. Whether you're doing protected buy right, whether you're just buying normal shares, just for like you've always done, or whether you want to do the Jones strategy. Okay? Now remember, the Jones strategy is to buy call options that relate to shares that are going up. And the Jones strategy, by the way, which we haven't realised, Joan hasn't realised it even herself, is to buy put options that relate to shares that are going down. If that is the case and we want to buy some put options, what do all three of these have to say? They have to say down. They have to say down. All three of them must say down before you would consider buying put options. Now, the secret to trading is to never trade against the trend. In other words, if it's all saying then go that way. So if you were thinking about buying shares just based on the chart, what would you want to see? You'd want to see it in a uptrend. Fantastic. Because in a duh trend is for duh. Yeah. Yes. So what I'm basically saying to you is the thing that is key, if you want to keep things simple, is to follow the trend. If you don't want to, if you're not interested in getting into all the complicated reading about companies and their financial statistics and all that sort of stuff, and you just want to keep it simple based on a picture, just follow the trend. And I can guarantee you, anyone who's actually had any experience of doing this, the one thing that eventually would have bitten them on the bum financially like they've never seen is when they ignored the trend or went against the trend. So that's why I say never trade against the trend. Rules about buying shares. So this applies to any trending market, okay? These rules apply to any market that goes up and down. So be it property, be it shares, be it whatever. These rules will apply. Never buy or sell shares without checking a chart first now that you know about them. Because how else would you determine the trend? Yeah. Never buy shares because they appear cheap after getting smashed. Yes. There is a strategy where if you know that the company is a good company but it's just out of favour with the market temporarily, then you're buying a great company at a bargain price. But unless you know how to determine if it is a great company at a bargain price, stay away from downtrending shares. Do you get the difference? So unless you know how to read about dividends and earnings per share and equity and growth in equity and all that sort of stuff, the way that Warren Buffett does it, just stick to shares in an uptrend. Now, I did tell you there's nearly 4,000 shares in the Australian market. Why would you ever want to buy downtrending shares then? Yeah, you've got plenty of choice. Never buy shares in a downtrend. There we go. Don't hang on to shares that are in a downtrend. Always be consistent. Buy shares in an uptrend and sell shares when you know they're in a downtrend. Therefore, if you're going to do Jones strategy, only ever consider buying call options that relate to shares that are in an uptrend. And you would only then purchase put options that relate to shares that are in a downtrend using this method.